All right. Good evening, everyone. Welcome to our exclusive webinar on unlocking wealth, essentials of real estate investment syndications. We appreciate you taking the time to join us. I'm Anchal Dwivedi, managing partner at Goldstone Capital Ventures, and I'm here with my fellow managing partner, Dinesh Nayak, and our esteemed guest speaker, Kyle Swafford, founder of Swafford Law Firm. At Goldstone Capital Ventures, our focus is on identifying, underwriting, acquiring, and managing commercial assets with significant value add potential. We transform properties into vibrant communities, offering financial rewards for our investors and desirable living spaces for residents. Our mission is to provide exceptional real estate investment opportunities, ensuring the success of our clients through strategic asset management and innovative solutions. If you can go to next slide, Dinesh.
Okay.
The one with
Okay.
yeah, this one. You can take a picture of this slide, schedule a call with us to learn how you can become a partner in our future investment opportunity. We also develop brand new apartments and other commercial assets like retail strip centers. To date, we have acquired over 16 real estate assets totaling more than 1,600 units in prime locations across North and South Carolina, Texas, Tennessee, Wisconsin, Florida, and other states. Our portfolio includes value-add apartments, ground-up construction, student housing, assisted living facilities, short-term rentals, and more. We are expanding into Virginia and other potential markets actively, exploring industrial and flex spaces due to growing demand. We are also looking for medical buildings nationwide to add to our portfolio. Additionally, we have a very robust due diligence process, leveraging data-driven insights to maximize return while mitigating risk. Our team's expertise spans market analysis, underwriting, ensuring that every investment is positioned for optimal performance. Now, I'll hand it over to Dinesh, who will walk you through our current portfolio and latest acquisition, and also introduce our guest speaker.
Thanks, Anchal. Welcome, everyone. Good evening. Basically, I have only few slides of the most recent properties that we have acquired. This one is an assisted living 125 beds Serenity Villa in Wisconsin that we bought last year in Slinger, Wisconsin. 125 beds. I think this was built between 2005 to 2015, and it's performing really well. There is a huge demand for assisted living now, and this is 100% occupied, and few people are on the wait list already. So we have already made two quarterly distributions on this since we acquired in October. This is student housing, 252 beds just outside Nashville, MSA. This was built in 2016, just 0.1 mile from the campus, Middle Tennessee State University campus. And we got it at a very low fixed rate Fannie Mae debt, which was like 4.38%. So it's performing well too. There are a few other properties. This is a property in South Carolina we acquired in 2022. Oh, I would like to talk a little bit about this one. This is a new construction. We acquired the land, 15.1 acre in just outside Winston-Salem downtown. This is right next to the I-40 highway and Haynes Mall, so 184 units. This is once we close on the loan, this will be the construction will be underway on this one. This is another property that we acquired in 2022, doing pretty well. Short-term rentals, 44 units, just outside Cowboy Stadium. Cheslin Place, these are like 49 duplexes in Spartanburg, South Carolina, just outside BMW manufacturing plant. Shaftwoods, this is a Class B 40 townhomes in South Carolina, again in a Class B location in Charleston. We we have few more, but I have not listed here. But uh, while we acquire these properties, we go through a lot of analysis. We have our own criteria that we go through. We do the market analysis, we do the sub-market analysis, we look at all the location-specific metrics like population growth, job growth, crime, and then go into the property-related metrics. How are the current rents? What is the market trend? Then is there any rent upside if we buy this? What is the value add opportunity? Then go and check all the expenses related to taxes, insurance, the contracts, maintenance, repair, all these kinds of analysis we do. And once we complete our underwriting, we our team does the underwriting, and then we review it thoroughly and select the property to buy. So it requires a lot of even to zone in on one unicorn property, we have to look at least 50, 60 properties. It takes a lot of time. And we use syndication process to scale up our acquisitions and our portfolio. So I would like to introduce Kyle Swafford. He's one of our friends, and he has been helping us in our a lot of deals. He is he's recently formed his own firm, uh, Swafford Law Firm. He received his bachelor from Delta State University. Then he went on to earn his Juris Doctorate from Mississippi College School of Law, where he clerked for then Mississippi Supreme Court Justice Kitchens. In addition, Kyle participated in the University of Florida Levin College of Law's top-ranked tax law program. At Swafford Law Firm, Kyle is a corporate and commercial real estate practice group member, and he represents clients in various matters. He lives with his wife Carly and their son Harrison. And Kyle, the podium is yours. Please go ahead and introduce yourself a little bit more and get into your presentation.
Absolutely. Thank you, Dinesh. They're right. My name is Kyle Swafford. I founded my law firm in January of 2023, where we focus on commercial real estate representation in terms of acquisitions, development, or dispositions, as well as Securities and Exchange Commission, SEC compliance. You typically see that in the form of syndications, which is predominantly going to be the focus of conversation this evening. A lot of syndicators in this space now, or let me rephrase that. A lot of commercial real estate investors this day and age are syndicators more so than in the past. A lot of that is because there's a lot of coaching programs that align with that. People have figured out that you can go further faster through partnership type efforts. And that's essentially the crux of a syndication. It's a partnership between what some people would call the GP team or the manager team, and they're in a partnership with you, the passive investor, where you're investing capital in the deal, receiving preferential treatment and liquidation and cash flows, and that's kind of the way that you work hand in hand. The best example that I've ever heard given was someone referred to a syndication as a relationship between a pilot and the passengers. The passengers perhaps don't have the experience to fly a plane, and the pilots need the passengers that are providing the capital so that the plane has a destination to go to. A pilot without any passengers has no need to fly, and passengers need the pilot to otherwise steer the plane, so to speak, right? And that's exactly how I kind of think of a syndication. Your GP team, the managers are the pilots, where they're underwriting the asset, negotiating the loan terms, running the property, increasing the rents, refinancing, handling any capital expense items such as repaving the parking lot, painting the facility, making it nice, safe for the tenants. And then the passive investors in a syndication are like the passengers in the plane, right? That you are contributing capital so that the property can be bought and run by the managers. So that's what a syndication is basically the passive investors coming together, pulling all their funds so that the managers can deploy it in an asset. Sometimes you can syndicate an apartment complex, you could syndicate a assisted living facility, a self-storage facility, a portfolio of short-term rentals. Really, the asset is not limited by any constraints. A lot of people will syndicate debt. They'll raise money and then the manager will provide it to borrowers and take a first position, right? So it doesn't necessarily have to be for an asset itself. It could be raising capital for the placement of future debt. So that's what a syndication is as a whole. Dinesh, do I have access to share my screen? Is that something I can do? Oh, it looks
Yes.
like I can. Oh, perfect.
You should be able to.
Okay. Is my screen shared currently?
Not yet.
Oh.
Okay, now yes.
Okay. Can you see an org chart? I can't.
We do, yeah, I guess.
Yes.
Okay, so this is a organizational structure of what a syndication typically looks like. And forgive me for looking away from the screen. You have Apple Creek Apartments in this example. It's a apartment complex in Atlanta, Georgia, right? And this entity may or may not be necessary. That's the lender. This is just the entity that is actually going to own the property. And here you have the holdings entity. This holding entity is where all of the passive investors invest their capital. And you can see that this syndicated entity is the syndication. This structure is surrounding this green entity. This entity is managed by the managers, which is kind of what I indicated a second ago. And then that GP team can be comprised of Goldstone, my group, or anybody else, right? It doesn't matter. They all come together for a sole purpose of the acquisition of this apartment complex down here. So this is what your typical structure would look like. The roles are rather simple. As individual passive investors, you are placing your capital into this company that is ultimately going to funnel the money down into escrow at the time of closing to purchase this property. And then the managers will contribute capital as well and sweat equity in running the facility and handling all the work. As a passive investor, you never have to worry about guaranteeing the debt. As a passive investor, the lender's never going to come after you. In most instances, the lender doesn't even know who you are. As a passive investor, you don't have to deal with the property manager, the tenants, or anything of the fold. You simply get to invest and sit back and enjoy the benefits that your investment gives to you. Whereas the managers are busy from day one. And by day one, I mean getting the property under contract. When they get the property under contract, they go and tour the facility. They show up with a surveyor. They they resurvey the property. They look at the roof. They look at every single unit, make sure every unit is accounted for. They review all the leases. They look at other properties in the area to forecast what they think rental growth will be over the next 5-year period. They look at market trends, strategies, where the property is located. And that's just at a minimum what they do. Then when they actually acquire the property, they have to run it. They have to meet projections. They have to get the property manager in check, make sure that the rents are going up at a certain rate that they should be, make sure the property is staying, it has a high occupancy level, meaning that tenants are staying in it. Ideally, tenants would stay and never leave. That would be a sign of continuous rent growth, positive rent growth, a positive culture that's being built on the property. And that's the roles that they're partaking in. They're doing all those services on your behalf. And of course, there's a split of the income proceeds with the passive investors collectively, typically taking a larger portion. So this is an example again of the syndication. In a syndication, you're going to receive legal documents as a passive investor. Is this about, am I going at a good speed here, Dinesh and Anshul? Is this good?
Yeah, this is great. Yeah, yeah.
Okay. When you are investing in a syndication, you're going to get what is typically referred to as a syndication package. That typically includes a private placement memorandum, also referred to as a PPM, a private placement memorandum, also known as a PPM. You're going to get an operating agreement, which is how the LLC is going to be operated. And then you're going to get a subscription agreement. The PPM, I'll explain each, and then I'll kind of give a little bit of table of contents examples as to what they provide. A private placement memorandum is typically a one-stop shop. It has a little bit of everything. It has the financial analysis. It has a description of the property, how many units, what's the business plan, what our renovations are going to be. It's got snippets of the operating agreement, how cash flows are going to be split. And then it has a little bit of the subscription agreement, which are who this investment opportunity is for. So it's got a little bit of everything. Typically, a PPM has 3 attachments: the operating agreement previously mentioned, the subscription agreement previously mentioned, and then an investment summary. The investment summary is typically a pitch deck or a slideshow presentation that is a little more specific. It has pictures of the property. It has pictures of neighboring properties. It has typically a forecast of the average income in the area. It has how many occupancy units that the property has, and a lot of pictures before and after renovations that could take place, and then rental projections, right? So the investment summary is very property specific, and the PPM has a little bit of that. The operating agreement is what it sounds like. It's the agreement as to how the company is going to be operated. The company is going to be operated by the manager. The manager is going to determine everything. The manager is going to determine whether we sell, whether we refi, if we fire the property manager, if we hire a new one, if we self-manage. The manager, in this instance, Apple Creek manager, is going to determine everything that Holdings is going to do, which is then going to feed all the way down to the apartment complex itself. So what you're going to do is, when you get that operating agreement, you want to see the rights of the members, right? And you want to see, what voting rights do I have? Typically in a syndication, you have very little. The whole reason that this investment is being presented to you is so that it can be passive. You don't have to deal with the phone calls. You don't have to deal with the weekly headaches. You just sit back and get to relax on your investment. But you're going to see in the operating agreement how cash flows and profits are going to be generated, how we're going to depreciate the asset for tax purposes. Who are the members? How often do meetings have to take place, if at all? Where venue is appropriate in the event that some dispute happens, definitions, terms. That the operating agreement is that one-stop shop that kind of covers everything as to how how the syndicated entity, the company, is going to be run. Then you have, last but not least, the subscription agreement. The subscription agreement is an agreement as to you subscribing to the company. So the operating agreement dictates how the company is going to be run, but the subscription agreement is a lot of information about you, the company, and SEC compliance, right? So the subscription agreement is going to ask, are you an accredited investor? If so, how? An accredited investor, as you may know, is any investor who has a net worth of $1 million or more, excluding their primary residence, or they make $200,000 a year, $300,000 a year if married for 2 of the last 3 years, with the 3rd year reasonably believing to be the same. So an accredited investor is someone that the SEC has clearly defined this role. Sometimes in a syndication, it's allowed for non-accredited investors. These are individuals who are not accredited but otherwise sophisticated. For example, say that you're a doctor that just got out of residency school and you make $400,000 a year. You're a sophisticated individual because you're a doctor, right? And you make a lot of money, so you probably are tight as to where you place it, but you're not accredited yet because it's your first year of residency and you haven't met the $1 million and you don't have the $1 million portfolio and you don't have you don't have the 3-year requirement of income, right? So there are instances where you could have a significant net worth, but you're not accredited yet. So there are instances where that could occur. But yeah, so just to recap, you have a PPM, private placement memorandum, which is a one-stop shop of all the facts that you need to know about the offering. You have the operating agreement, which dictates how the company is going to be run. And then you have the subscription agreement, which dictates your agreement with the company as to how you're subscribing to it as a member and how that takes place with the SEC. And then typically you have an investment summary, which is a pitch deck typically provided by the sponsorship team, where it kind of gives pictures and illustrations of before and after and business plan and all that. So that's what you would typically find. Here I'm going to open up a example of when you're reviewing a PPM, what you would kind of want to look for. Can you see is there a table of contents on my screen?
Yeah.
Yeah.
Okay, great. So typically all syndications, one way or another, have a table of contents, and it breaks down certain terms, who it's for. And if you're a passive investor, it's important that you read the entirety of the document. You are the managers, the GP team, while they are going to be partners with you, they can't be expected to give you tax advice, financial advice, read this document on your behalf. At some point, as a passive investor, you have to take that responsibility yourself. So you may say, okay, well, what are the important parts of a PPM? What's basically going on? Well, I don't have the entire document here because I don't want to share another group's documents that hasn't given me the authority to do so. But you can see in this particular PPM, there's an executive summary that kind of basically tells you everything that you need to know about the offering. Then we have some investment objectives, what we're striving to do, what we're wanting to do. The management, who's going to manage this thing? That would be important to know, right? If you're a passive investor, who is that comprised of? Oh, compensation to the manager. How are they being compensated? Are they charging any fees? Are they telling me that it's a 80-20 split, but it's really a 60-40 when you look at the fine print, so to speak, right? How the manager is compensated would be incredibly important. Conflicts of interest. Is there anything that the managers are doing that benefits them aside from their compensation? Sometimes in a syndication, let's say that there's an apartment complex, right? And it's in Atlanta, Georgia. Maybe one of the members on the GP team has a landscaping company, and maybe that landscaping company is the one that's going to cut the grass, install all the landscaping, the shrubbery. The managers may contract him to do that work. Well, that might be a conflict because that person is receiving compensation from the project apart from typical ownership splits and whatnot. So they would disclose that we're going to contract this person, we trust him, we like his work, yada yada. But maybe there's a conflict of interest that needs to be disclosed. The responsibilities of the manager would be important. What are they going to do? Is there anything that somebody else is going to do? Risk factors, very huge. This is probably the most important section that you want to pay a part to. What are the risks associated with investing in this project? The risks may be related to real estate. Maybe it's the market area. Maybe the risks are associated with debt servicing, because typically you're acquiring this property with a lender. There may be risks associated with the debt, i.e. the debt is in a higher priority than your investment because they have a first security position. If they sell a property, the first thing that you would do is pay off the debt, right? Whatever portion is left over would go to making you whole. Then you would split profits after that. But the lender is going to be in front of you. So there may be certain risks associated with a foreclosure, God forbid, or with mortgage payments. So we want to look at risk factors around that. Maybe there's risk factors in construction. right? There's construction delays sometimes, or the supply chain doesn't open up like we thought it would. And there are risks associated with construction, with rehabbing, all calculated risks, no doubt, but risks nonetheless that you would otherwise need to pay attention to. Typically in a PPM, and I should have indicated that this is a table of contents for a PPM. Sorry if I didn't say that, but you can kind of see what I meant earlier, how a PPM is a one-stop shop for everything. It's got the nature of it, what it's for, who the management is. Now you can see that we're getting into tax considerations, right? Usually the PPM is going to say, we're not CPAs, right? We're not financial planners, but typically this is how the taxation of a partnership like this would be structured. We have a summary of the operating agreement, key terms, right? Remember how I said earlier, the PPM is going to mention a little bit of the operating agreement. You can already see here where that would be true. And then some confidential information, and then the procedures to subscribe. You can see here, like I said earlier, that a PPM has attachments to it, a subscription agreement, like I said, the company operating agreement, like I said, and then these questionnaires are typically involved in the subscription agreement, but the investor questionnaire is typically your name, your address, your information, your wiring information, your banking information, and how you want to own your subscription, how much income, if you're accredited, why, if you're not accredited, you would check the box that you're non-accredited, things like that. So you can kind of see here that earlier, what I was saying all kind of summarizes right here in this table of contents. So now you may be saying, okay, that's great, but so what? What else what should stick out to me when I'm reviewing a PPM? I have here the executive summary pulled out of this document. I want to disclose I did not create this document. This document is not for a client of mine, and I have changed the company name. You can see that it says 000 Company LLC. I changed the name of that to give anonymity to those who prepare this document. But you can see here in this executive summary, they mention the company, they mention the manager, they mention some of the portions of the operating agreement, they mention the membership interests. But now you kind of see we're on the first page of the summary, and there's already like, this doesn't line up with this. It says the max raise is 200,000. That seems low, right? So like if I wanted to invest 500,000, am I allowed to? It just seems a little off, right? We're already kind of seeing this group drop the ball. It's not aligned here. It's not aligned here. It's not aligned here. It's not aligned here. This number doesn't make any sense, but let's just keep going. Okay, fine. It's fixed. Leverage, the term, target assets of the company, the investment restrictions. But here we go again. Things are starting to get off a little bit. One of the things that I noticed, because I prepare these documents so much, and maybe it's just because of the nature of my trade, but if a group is asking you to make at a minimum a $50,000, $100,000, $200,000 contribution, you should make sure that their documents are at least aesthetically pleasing, are at least line up with one another. This kind of looks sloppy. Now, an attorney no doubt prepared this. It's not necessarily the sponsor's fault for the document the attorney poorly drafted, but did they review it? If they didn't even review their own PPM, how do you know if they reviewed the documents or how well they underwrote the property for you? So presentation is key. So if you're reviewing a package that looks like this already, where just the small attention to detail is a little off, it should beg into question their other operations, or at least it would for me. But you can see again in this summary, how distributions are going to be had. There's a 6% or 8% return. Then 100% of the remainders to the manager. This was a debt fund, so it's a little different from what I was saying earlier. You can reinvest your capital. You can just kind of see, but now there's huge blanks. Why are there huge blanks? There's just these, it just kind of, again, it brings into question the experience of the attorney that prepared it and the sponsor that did it, right? But again, the point of this is to kind of indicate certain aspects of the table of contents and how the PPM kind of works together. Another question, another example from another offering, again, a document that I did not prepare for a client that is, and it's not a client of mine. I want you to be aware of what you're reading. So in this deal, they're raising $5 million and they're offering 5 shares, A1, A2, A3, A4, and A5. But now look at what that really means though. Okay, fine. A class A1 unit has a hurdle, and they're going to get, their a 3.5 equity multiple. They're going to be redeemed. It's a forced redemption in this particular offering, right? So when you make your investment, they have a right to forcibly redeem you at an equity multiple of 3.5x or after a 5-year investment. What does that mean? What if the deal doesn't cash flow because this was a particular construction project? What if, 5 years in, I haven't made my 3.5x multiple? Oh, well, you're redeemed. And you'll notice that all of these kind of have that, a forced redemption where there's no clear path of recovery. So sometimes a sponsor will think in their head what they want to do with this investment, but then they put language in here that is actually against the investor. I can personally say that Goldstone has never done that. And again, this document is not Goldstone's, but I just want to point out that you should read the documents and you should be aware of what you're agreeing to. And a good sponsor would have never allowed some sort of confusing anti-passive investor documents like these. So when you're considering investing in a syndication, you should ask yourself, what's the return? What's the minimum investment? Sometimes a syndicator has different share classes for amounts of contribution. Somebody that invests $100,000 may get a 6% preferred return, but somebody that invests $500,000 may get an 8% preferred return. So you might want to ask yourself, if I get more money, if I contribute additional capital, do I get anything for that? Right? That may be something important you want to know. You want to ask yourself, what are the risks here? You want to review how how proceeds are split from profits, how they're split from refinance, and how they're split upon a sale. Just because there's a refinance, you want to say, hey, now's a good time to give us our money back. Do they have to? Is it in whole or in part? Is it complete? You want to check those things. At sale, you want to make sure that you're getting your capital back. So what should you do as a passive investor? You should ask questions. Apart from the documents and making sure that you read them, making sure that they make sense, and making sure that they are accurate, you should ask yourself, what about this target? Where's my downside? Right? Warren Buffett made his net worth because he refused to sell, and he always tried to grow a little bit every year. He didn't try to win 100% every single year, right? He just wanted to win a little bit at a time. That's how you preserve your wealth. So you might ask yourself, what are my downsides here? You might ask the sponsor that. What are the downsides to this investment? Typically, the downsides would be the lack of rent growth that you were anticipating. But, you want to ask, what similar properties have you purchased that are like this one? You might ask, have you been in this target market before? If you have not, are you in a target market similar to it, right? Maybe just because this is the sponsor's first deal in Austin, Texas, doesn't mean that they have no experience at all because they have an existing portfolio in Dallas, Texas, for example, right? So you might want to ask, what is your experience? Have you sold any properties that you've acquired? Have you sold any, and what were those returns? You might ask, have you at least refied any of them? Were investors able to get their capital back? You might want to ask their background. If they're a first-time syndicator, that may be a little worrisome. If they have an existing portfolio of their own, maybe it's not so much of a concern. Like if the syndicator's first syndication, but they have properties in their existing portfolio, then they've at least been in real estate already. But if someone, for example, has only a couple of rental properties and they're getting into the space, you may want to ask what experience they have in other areas to feel more comfortable with investing capital with them. I think those would be, tell me more about the asset and tell me more about neighboring assets. What are you trying to do with the property? What's your business plan? The business plan may be buy it, increase operating efficiencies, renovate, refi, and or sell. You want to know the business plan of the sponsorship team before you invest capital with them. And then what should you do? At that point, you should review the documentation with your financial advisor, or if you feel comfortable reviewing the documentation on your own, review the documentation on your own. It's not the role of the attorney who prepared the documentation for his client to review that with you, because there's a potential conflict there. So you may want to get your own attorney to review it, or you may just want to review it on your own and think about the areas of focus in the PPM that I mentioned earlier. And then you should ask for the wiring instructions, and then you should wire the funds. And then once the property is closed, typically a good operator would give monthly updates, how the property's going, what the occupancy is, where the average rental income is for renovated units versus non-renovated units. And over the course of time, maybe they give minor monthly updates, but they give great quarterly updates. You can see that too. And then that way you have a larger framework instead of just month to month. And then you can see how your investment's doing. And typically that's when it'll start cash flowing. And then that's when you'll start to get your distributions. And then hopefully upon a successful disposition, that's when you'll see your income return to you with the profits and the upside that you were expecting. And hopefully it's a little bit more, right? So that's what you should expect. So that's all that I think I have to say, Dinesh and Anshul. Do you have any questions or want me to follow up on anything else I said? Are there any questions from those in attendance?
Yeah, if any of you have any questions, you can put them in the Q&A box, or if you can raise hand, we can enable you to talk. So either way, it's fine.
Maybe while we are waiting for a question, Kyle, if you can cover just very brief, what's the difference between syndication and joint ventures?
Sure. So yeah, I can do that. So a syndication is basically what I mentioned earlier, right? You have passive investors who have a preferential treatment on the income, and then you have the management team that is getting an ownership interest in the profits because they're doing all of the work, right? A joint venture is a little bit different. A joint venture is where people come together with equal voting rights to determine how to run a property. There may be somebody that decides to be the point for that, but everybody has a voting right. Now, somebody may be 10%, somebody may be 20, 25, right? You can get outvoted, you can be a minority partner, right? But a joint venture is a situation where maybe I like to think of it as 5 people come together to purchase an asset. They need $500,000 to purchase this asset, and each of them gives $100,000. Right. And then one of them kind of is going to take the lead on managing the asset, or maybe, a couple of other people bring in the money, he brings in the work, and then they all decide what to do together. Right. So a joint venture is where everybody gets to vote and then the majority rules. Whereas in a syndication, the managers are running everything because they have the sophistication and they have the experience. That's typically the difference. In a syndication, you have a manager that determines everything, and in a joint venture, you have a managing member who performs what the members vote on. So that's the distinction.
Thanks, Kyle.
Absolutely.
Do you want to cover the fund model? Okay, let me. Okay. Yeah, go ahead, Rakesh.
Hey Dinesh, hey Anshul.
Yeah.
Kyle, I have a question. Do you have any particular state which you recommend for setting up the LLC, or any recommendation how to set up the LLC for the syndication?
Are you asking, like as your investment vehicle, or are you asking about the syndication itself?
Investment vehicle.
Okay, so as your investment vehicle, you can kind of do it one of two ways. You can typically, you see a lot of people create an entity in the state that they live in, because you're otherwise going to get taxed there based on where you live. Some people, however, will create their investment entity in Delaware. And the reason that they do that is because they like to keep anonymity. Now, typically, you don't have to invest in an LLC if you don't want to. You can typically invest jointly with your spouse or as an individual. Since you're not managing the property and since you're not guaranteeing the debt, like I said, there are many instances where the lender doesn't even know your name. There's not a whole lot of risk in you investing in your own name. Typically, the sponsors too don't tell other investors who their other investors are. So, like, if I'm a passive investor, Anshal shouldn't, in his deal, Anshal should not tell me who other people that are investing in this deal, nor should other people be told that I'm investing in this deal, right? Now, sometimes passive investors just know each other, and maybe you and I agree to always invest side by side, and maybe at that point, knowing that relationship, Ansha will say, well, hey, Rakesh was going to invest or you, and I was like, oh, well, if he's going to do it, I'll do it, right? But typically, because it's so anonymous, the very nature of it, and private by its very virtue, you typically don't have a lot of situations where you have to invest in an LLC. Sometimes an entity already exists because that particular investor just holds all of his passive investments that way. Then
Okay.
you could do that. But a lot of instances, you're perfectly fine investing as an individual.
Okay. Sounds good. Thank you.
But to answer your question, though, I would focus on the state that you live in, or Delaware if you want to keep things a little more anonymous. But given that it's solely for investments for your own benefit, you're probably fine creating an entity in the state that you're located.
Sounds good. Thank you.
Absolutely. Oh, one thing I did want to mention, since you kind of brought that up, a lot of times there are estate planning considerations that happen to us unsuspected in a lot of instances. In the documents, in the syndication documents that I prepare, and most attorneys prepare, you're allowed to transfer your interest to your spouse, or transfer your interest to an estate, or excuse me, a trust that you ultimately create, right? If you never did that and sadly passed away, the manager would be allowed to transfer your interest to your estate, so that it can be probated in accordance with your state's law. So don't think that you can ever transfer it for estate planning purposes, or in the event that you have other considerations. You're perfectly allowed to do that.
Got it. Okay.
Good question, Rakesh.
Thanks.
Mukul, I think you had a question, or?
Yeah, I saw someone else raised hand also. Yeah, you can either raise your hand or you can put it in QA box. We'll answer that.
So, Kyle, I have a question. There is, some in these syndications, the money is locked for the duration of the transaction, right? most of the
Mhm.
cases.
Mhm.
So sometimes there are instances where the investors ask, okay, can I pull the money out? Or how can I pull my money out of this deal? I have some kind of emergency. So can you cover that?
Yeah, I can. So the whole reason that this document, well, I'll answer, a question came in, but I'll answer your questions first, Dinesh. Typically, your interest in a syndication is non-transferable. That's to be compliant with the SEC. Now, sometimes things happen and sometimes, things change. So you're allowed to transfer for estate planning reasons. The SEC, of course, allows that, but you're not typically allowed to subscribe and purchase this interest and then sell it to someone else, particularly if that someone else was never known by this team to begin with. And the manager wouldn't want that either because he had a relationship with you. He didn't have a relationship with this person he's never met before. So you're typically not allowed to get your capital back. In some instances, companies will have redemption language that that where that can happen. But the problem is, how do you value it? Are you valuing it as of right now, or are you valuing in the upside for future growth that is yet to be determined? Right? Because property values can go up and down based on presidential candidates, let alone interest rates and other economic influences, right? So you're typically not allowed to demand your capital back. That's why it's important to underwrite the deal itself and underwrite the group that you're with. Good question.
Okay, thank you.
All right, there's another question, which is, how do you determine and manage properties across practically all US? Do you have deals with property managers, or is it an area you focus in? I think this is a question for Goldstone specifically, I think.
Yeah.
Question.
Yeah, actually, yeah, Mukul, that's a great question. So if the property is not located in the state we are living, we actually partner with other folks who are actually called boots on the ground. So they stay close to the property. And we also do an asset management call every week for every property and see how the property is performing. So basically, to answer your question, we always have someone who is living very close to the property. That's boots on the ground. Yeah.
Yeah, for day-to-day management, we hire property management companies. So they take care of the day-to-day maintenance, repair, leasing, all the activities. So, and we have our weekly meetings with them just to see the metrics, how the occupancy is, how the rents are going up, and basically overall health of the property by itself. So.
Mhm. One last tip I think that I would give a passive investor is, if they are interviewing, so to speak, or underwriting a sponsorship team, one of the things that you should ask is, how many so a lot of times syndicators will say they have 2,000 doors, or they may say they have $200 million of assets under management. Well, $200 million could just be 2 deals, right? That are highly expensive in Los Angeles and Miami, right? That doesn't mean you have a lot of properties. It just means you have a lot of valuation, and the valuations can come and go, right? So then you may want to ask, okay, well, the doors, if somebody says, I have 1,000 doors, that's typically pretty impressive, because it at least means that they have one large property or a combination of multiple size properties. So I would focus on how many doors someone has as opposed to how many assets under management they have, because assets under management is basically just what you decided to pay for it. That doesn't necessarily mean that doesn't have any indication of how you have effectively managed the portfolio. Whereas if you have 1,000 doors or more, you have done a lot of different properties and scaled in a bunch of different ways. And a question I would ask is, of those properties, what is your managerial stake in that, right? Because sometimes, again, this doesn't apply to Goldstone, but sometimes a sponsor will only have like a 5% interest in a 100 unit portfolio, right? But they'll say, I have 100 doors. It's like, yeah, but like you only have 5%. Like you're pretty small on the deal, right? Like you may not even be, you may be getting outvoted at every turn and not really know what to do yourself yet. So you always want to ask, like, of the doors that you have, how many of that would you say you're a key voice in those operations? And that would also be pretty important to me. Yeah, so just wanted to mention that. Any other questions? Goldstone crew?
Yeah, Mukul, you can talk. I think you can, you're unmuted, I believe, or you can unmute yourself and talk. Looks like you had,
He may be unmuted, but his speakers may not be picking up his reception. That can happen sometimes. But okay. Well, it seems like that's all the questions in the questions and answer box. Or if there are other questions, it seems to be more focused on your portfolio and experience, which are good questions that you should ask. So it looks like maybe this presentation helped after all. Anshul, Dinesh, it's always a pleasure getting to talk with you guys. I've always enjoyed my time working with y'all. I think y'all are a top-notch group, and it's always a pleasure to kind of be involved in your transactions, at least on the legal side. And I look forward to working with you more in the future. Good luck on your current deal. And I wish you the continued success. To all the attendees, thank you for participating, and good luck as you continue and looking for investment opportunities in this market as well.
Yeah, thank you. Thank you so much, Kyle. It's always a pleasure speaking to you. It's always it's a great learning for everyone. Yeah.
Absolutely, no problem.
thank you so much for your time. It was a
Absolutely.
kind of a short
y'all.
notice.
Oh, no problem. No problem. Thank you. Bye.
Have a good day.